Hi guys, welcome back to the YouTube channel. In this video, we're going to talk through everything you need to know when it comes to starting and running your very own limited company here in the UK. We're going to talk about what expenses you can claim, how to get it set up a Companies House, what you need to know about corporation tax, annual accounts, paying yourself, and everything in between. Make sure you stay to the end so you don't miss out on any valuable tax-saving information. So the first thing you'll need to do if you're looking at setting up a limited company and do a business in the UK, well, is actually setting up the limited company. You need to do this with Companies House. You need to find a company name that isn't taken. If you Google company name checker, you can see what names have already been taken because most of the good ones already have, and find one that isn't. And then when you've got this, you can register your company with Companies House. You can either do this yourself or get an accountant or online formation agent to do it. If you haven't done it yourself before, it's probably best just to pay a couple of £100 to get somebody to do it for you so that you know it's done correctly. Quite often we see potential clients come to us and they've put a high number of shares or a high par value per share, and this can actually cause tax problems later on down the line. And also, if you're looking at setting up your business with somebody else, you've got a business partner, you're a married couple, husband and wife, and you're running your business together, there's usually tax-efficient ways of doing this, such as having alphabet shares, which will usually allow for different levels of dividends to be taken, rather than if you just set up your company yourself with Companies House, single class of shares. Dividends legally have to be taken in proportion to shareholding, and you want to avoid that if you've got different income tax rates between you and your business partners or spouse. As a limited company, your profits will be subject to corporation tax. And it's important to remember this because a lot of people kind of confuse limited company profits with income tax rates. And a key distinction here is limited company is a separate legal entity. It's completely separate from you personally. It pays its own taxes. If you want to take money from your limited company, you might pay additional taxes when taking money out. And more importantly, a limited company will pay tax on its profits, corporation tax. And the rates for corporation tax vary depending on if you've got a number of associated companies, but assuming that you've only got one limited company, the profits are relatively straightforward. So for the first £50,000 of profits, you'll pay tax at 19%. On profits between £50,000 and £250,000, it will be 26.5%. And then profits over the £250,000 mark will be taxed at a flat rate of 25%. And when it comes to filing your corporation tax return, you've got 12 months to file your corporation tax return after the end of your accounting period. So as soon as you set your limited company up, usually to the end of that month, if you set it up now, where are we, November? Your accounting period will be the next couple of days up until the end of November in 12 months' time. So for corporation tax, you've got 12 months to file your corporation tax return, but you've actually only got 9 months and 1 day to pay your corporation tax. It's a little bit backwards because I don't understand how you can potentially pay your corporation tax if you've not done your corporation tax return and actually know how much corporation tax you've got to pay. But those are the deadlines. Most accountants will get it all done well within that 9-month period as well. Get it submitted ahead of schedule so that you actually know how much tax you've got to pay. Each year, you've also got to file annual statutory accounts. These go to Companies House, and a reduced version are available on Companies House for people to see. There are potential changes coming this way. It's not yet been announced whether the profit and loss statement, which isn't usually shown on Companies House, is the affiliated accounts that get shown. There are potential changes coming to the legislation with Companies House that may actually result in all companies. Currently, it's only large companies that have to file their profit and loss accounts, actually making that public information as well. As it stands at the minute, all that goes to Companies House are the affiliated accounts, but you also prepare your full accounts and send that in with your tax return to HMRC. So now we know what we've got to do. Essentially, those are the key deadlines. What business expenses can we claim? This is a very common question. You've set up your company, and now what can you claim? Well, the good news here is anything that is a genuine business expense is pretty much always claimable. So if you're hiring an office because you need an office to work from, fantastic, that's a business expense. If you're getting branded clothing with your logo on it, that's a business expense. You can claim that. Other expenses, a laptop, you can have a laptop because you need it for your business. Directors are allowed a mobile phone, and that's not a taxable benefit. So anything that you are genuinely going to use for the benefit of the business, you can put through as an expense. I just want to pause the video here again to make sure that you've smashed that subscribe button so you get notified as soon as we post brand new tax saving content. Back to the video. And this extends further. So business travel. A lot of people travel a lot for business, and as long as the main purpose of that trip was for business and there was very minimal, ideally no personal enjoyment, no personal benefit, then that is absolutely a business expense as well. And of course, these are the direct business expenses, and you notice this because it's cash that's coming out of your bank account. You're incurring these expenses on your debit card. But what a lot of businesses miss are the soft expenses. Say, for instance, you're using your own personal vehicle for business purposes. Well, actually, you can claim 45p a mile for the first 10,000 miles, and then 25p a mile thereafter for using your own car, your own fuel, for the benefit of your limited company. And you can also do similar things as well for working from home. If you've got a home office, well, actually, you can either claim a proportion of your household expenses, rent that segment of your property to your limited company, and it pays you those costs back in return, or you can claim the £312 a year flat rate. There's quite a few different options in what you can actually claim and have your company reimburse you for personally incurred expenses. So there we have it, guys. You can claim pretty much everything that is genuinely for the purpose of the business. You can claim those soft expenses as well. But before we get too excited, the one thing you can't claim is business entertaining. HMRC flat disallow this. But that said, it's still good to put the business entertaining when you do incur it through the company card. Don't go thinking, okay, Josh said I can't get any tax relief on it, I'll just use my own personal debit card, because if you use your personal debit card, you've paid tax to get that cash in your bank, whereas even though you don't get a corporation tax deduction in the limited company bank account, it's still using the company's cash that you've not paid income tax on, so it's a much better outcome. Keeping business records is absolutely paramount, that you keep good quality records when it comes to your limited company. You can get pretty nasty penalties if you get found out to have kept inadequate accounting records. Always make sure you're keeping physical invoices or digital invoices. You've got apps like HubDoc, Dext, where you can keep basically you can forward in paper trails, you forward in emails, take pictures of receipts, because you'll need all of this in the event of a HMRC inquiry, and just to make sure you've got good sound system set up. For most of our clients, we get them set up on Xero or QuickBooks so that you've got your accounting records, you can see your profit and loss, see your balance sheet, track your income and expenses, because you cannot run a business just by either taking cash or by having money coming in and out your bank account and think, okay, my bank account's increasing this month, business must be doing good. That is not a way to build a successful business. You need proper accounting systems. For most businesses, get it set up with Xero, get it set up with HubDoc. This is going to allow you to just import your bank feeds, do your bookkeeping on a weekly or monthly basis. All of your invoices that you've got can marry through, and they're all safely secure in the cloud, so you can throw away the paper copies. You don't need to keep those. As long as you've got a digital copy of your expenses, of your invoices, of your purchase orders and everything else, that's fine with HMRC. And if your business is VAT registered, make sure that you are having the official VAT invoices saved on file. That include the VAT number, the amount of VAT, the addresses and everything else that's legally required for it to constitute a VAT invoice. When it comes to HMRC inquiries, as soon as you're VAT registered, that is an area that they actively look at a lot more detail than just your ordinary corporation tax inquiry. They will look at a VAT inquiry and they will want to see your VAT invoices. And if you've not got a VAT invoice, the chances are they will deny the input claim, and as a result, you'll have to pay back the VAT you claimed if you don't have the VAT invoice. And also, it's worth noting that as well, as Making Tax Digital becomes more prominent, it's going to be introduced for limited companies. It's already in place for VAT. You need to have online accounting software, have all of your accounts digitalised. You can't be using cash books and physical paper copies. HMRC don't like that, so you need to get set up now on some proper online accounting software. So now your business is set up, you've got your bank account set up, you've got your bookkeeping software set up, it is going well. Well, how do you start taking profits out of your limited company? How do you start paying yourself? So there are two main ways, well actually we'll say three main ways that you can pay yourself from your limited company. The first one, most straightforward, is a salary. So you as a director, it's not a form of employment, but it's an office, and as a result, you can pay yourself a salary. Usually, for most directors in the current tax year, and indeed moving forward as well, because all the tax bands have been frozen, £12,570 is still the most tax efficient salary. In order to pay yourself this and have it deducted in the accounts, you'll need to have a PAYE scheme set up, pay as you earn. And when you do this, each time you pay yourself, you have to submit a submission to HMRC showing how much you've paid yourself and any tax that's been deducted. Your accountant will do this for you. So once you've put your salary through, £12,570, use your personal allowance, then usually it's the case of most directors will take dividends from their limited company. As long as your company is making profits, it's got to be able to have positive reserves or show that a company is making profits in order for you to legally take a dividend. As long as you can support that, you can take a dividend out. It's important to mention here that dividends are paid out of post-tax earnings. So if you make £100,000, you pay 25% corporation tax, 25k, you've got 75k left in the bank. You can only pay the 75k of dividends after you've paid your taxes. It's not before. Whereas with a salary, that salary comes off of your profits, reducing the amount of corporation tax you pay. So salary first, dividends after. But if you're in a fortunate position where you're a property investor or you're in a capital intensive business where you've had to loan money into your limited company to seed it, you've got a director's loan account, you can usually charge interest on this at a market rate, 10 or 15%. That again is tax deductible, so it comes off of your profits, and you can usually receive this very tax efficiently. If you're a basic rate taxpayer of £1,000 tax free, £500 for a higher rate, and even then where it falls into your basic rate band, you'll only be paying 20% tax on this, which can be less than the amount of corporation tax you'll pay in. As a result, you're actually saving tax and getting money out of the company. Very rarely that happens, but in the tax world we call that an absolute win-win. And now just a little bit on VAT. So as soon as you've got a limited company set up, you must consider VAT. At least think, okay, is the trade that I'm in, is it VATable? Am I making VATable supplies? A lot of people watching this might be property investors. And a lot of property businesses are actually VAT exempt, which means you physically cannot register. If you're a property lettings business, buy-to-let landlord, you usually can't register. HMRC will deny it. Even if you're making £500,000 a year turnover, you physically cannot register. You cannot charge VAT on rent to tenants, and you cannot reclaim VAT on your expenses. But if you're a serviced accommodation operator, that is subject to VAT. As soon as your gross revenue in a 12-month window exceeds £90,000, you must register for VAT. The same with deal sourcing, the same with a plumbing business. All of these general businesses are usually subject to VAT. There's a few that aren't, so definitely make sure that you fully understand the supplies you're making and whether you need to watch your turnover for VAT or not. And now, to finish the video off, a couple of tax planning tips for limited company directors. So the first one, we touched on it. Make sure that you're paying yourself a salary. And even if you're not making massive profits yet, do make sure, because that $12,570, that's your personal allowance. So if you've left employment and you've started your business, you don't want that to go to waste if you've got no other income for the tax year. So what you can do is pay yourself a salary, even if the company's loss-making, use your personal allowance and just put it to your director's loan account so that you can take that out later completely tax-free. The same with your interest expenses as well, and even your dividend expenses. If your dividend allowance, if you think, well, the business doesn't quite have enough cash, but I want to take the dividend through, well, actually put the dividend through, add it to your director's loan account so that next year, when the company does have the cash to pay you, you could take that dividend out completely tax-free. The second is make sure that you are maximising your expenses. So anything that you're looking to purchase, if it is for the benefit of the business, phones, iPad, laptops, camera gear for properties, whatever it might be, if there's a business use for it, stick it through the business. And then the last one is pension contributions. As a limited company director, you can put £60,000 a year into your pension, and that's fully tax deductible in the company record, saving you corporation tax. That can go into your pension scheme completely tax-free and will grow tax-free as well. And a lot of people overlook this, but it can be a great way to minimise your corporation tax and actually build wealth. And that's all for today's video, guys. I hope you found it really useful. Please do remember to give the video a thumbs up and smash that subscribe button if you found this video useful. See you next week. Bye for now.